Introduction: Why dividends still matter in the world of investing. Trends come and go. One decade celebrates growth stocks, another glorifies speculative trading, and another becomes obsessed with short-term gains. Yet through all these market cycles, one principle has quietly endured: the power of dividends. Dividends represent something simple but profound. They are real cash payments made to shareholders, not promises, projections, or market opinions. For value investors, dividends are not just income, they are evidence. Evidence that a business generates surplus cash, evidence that management respects shareholders, and evidence that a company has achieved a level of financial stability. Benjamin Graham, widely known as the father of value investing, did not rely exclusively on dividends when selecting stocks. However, he deeply understood their importance. To Graham, dividends were not merely rewards, they were safeguards. They provided tangible returns even when markets became irrational or pessimistic. In this video, we will explore the role of dividends in value investing. Guided by Graham's principles and expanded for modern markets, we will explain why dividends matter, how they fit into a disciplined investment strategy, and how investors can use dividends to reduce risk, generate income, and build long-term wealth. This is not a video about chasing the highest dividend yield. It is about understanding dividends as part of a defensive, rational, and intelligent investment approach, whether you are a beginner or a seasoned investor. Dividends can play a crucial role in stabilizing your portfolio and compounding your returns over time. As we move forward, remember this key idea: dividends are not the goal of value investing, but they are one of its strongest allies. Benjamin Graham's view on dividends. Benjamin Graham believed that investing should be grounded in logic, evidence, and caution. His philosophy was built around the protection of capital first and the pursuit of profit second. Dividends fit naturally into this framework. Graham never claimed that a stock without dividends was uninvestable. However, he consistently favored companies with a history of stable and consistent dividend payments. To him, dividends acted as a filter, a way to separate solid businesses from speculative ventures. Why? Because paying dividends requires discipline. A company that pays dividends must generate real earnings and real cash flow. It cannot rely indefinitely on accounting adjustments, future expectations, or market hype. Dividends force management to confront reality. They also limit reckless expansion and excessive risk-taking. Graham viewed dividends as a sign of maturity. Young companies may reinvest profits to grow, but established companies should reward shareholders for their patience. A steady dividend demonstrated that a business had moved beyond survival and into sustainability. Importantly, Graham warned against overemphasizing dividend yield. A very high yield often signals distress rather than strength. Instead, he focused on dividend consistency, preferring companies that had paid dividends through recessions, wars, and market crashes. Into Intelligent Investor, Graham emphasized that dividends provide psychological and financial stability. When markets decline, dividend payments continue. This income reassures investors and reduces the temptation to sell during periods of fear. Graham also believed dividends helped investors distinguish between ownership and speculation. Owners receive income from the business. Speculators depend on price movements. Dividends remind investors that stocks represent partial ownership of real enterprises, not lottery tickets. In essence, Graham saw dividends as a form of discipline imposed on both management and investors. They encourage patience, realism, and long-term thinking, qualities that lie at the heart of value investing. Dividends, as a signal of financial stability, dividends are often misunderstood as simple cash distributions. In reality, they function as signals, messages sent by a company about its financial condition. To pay dividends consistently, a company must possess several strengths: stable revenues, manageable debt, predictable cash flow, and prudent capital allocation. These characteristics align closely with what value investors seek. A company struggling to survive cannot afford dividends. A company drowning in debt cannot sustain them. Therefore, a long dividend history often indicates financial resilience. From a value investing perspective, dividends reduce uncertainty. While earnings can fluctuate and stock prices can swing wildly, dividend payments tend to be smoother. This stability makes it easier to evaluate the true performance of a business. Dividends also impose accountability on management. Once a dividend is established, cutting it becomes a public admission of weakness. As a result, responsible managers are cautious about raising dividends unless they are confident in future earnings. For investors, this creates a valuable advantage. Dividends offer insight into management's confidence and long-term planning. A cautious, sustainable dividend policy often reflects thoughtful leadership, an essential element of value investing. Additionally, dividend-paying companies tend to attract long-term investors rather than short-term traders. This stabilizes shareholder bases and reduces excessive volatility. In uncertain markets, dividends serve as anchors. Even when stock prices fall, dividend income continues. This income can be reinvested at lower prices, accelerating long-term returns. For Graham-style investors, dividends were never about excitement, they were about reliability. And in investing, reliability often outperforms brilliance over time. Income vs growth, a false dichotomy. Many investors believe they must choose between dividends and growth. Benjamin Graham rejected this false dichotomy. A company can grow and pay dividends simultaneously. In fact, many of the strongest businesses in history have done exactly that. Dividends do not prevent growth. Poor capital allocation does. Graham recognized that reinvestment should occur only when it offers reasonable returns. If a company cannot reinvest earnings profitably, returning capital to shareholders through dividends is the rational choice. Dividends also create flexibility for investors. Instead of relying on capital gains, investors can decide how to reinvest income across industries, geographies, or asset classes. This autonomy is powerful. It reduces dependence on market timing and allows investors to rebalance portfolios organically. For retirees and conservative investors, dividends provide income without the need to sell assets. For younger investors, reinvested dividends accelerate compounding. Thus, dividends are not a limitation, they are a strategic tool that complements growth when used wisely. Dividends safety and common pitfalls. Benjamin Graham consistently warned investors against yield trap stocks with unusually high dividends that mask underlying weakness. A high dividend yield often results from a falling stock price, not a generous payout. In such cases, the market may be signaling trouble ahead. Graham emphasized the importance of dividend coverage. Investors should examine earnings stability, payout ratios, and cash flow adequacy before trusting dividend payments are sustainable. Dividend is supported by profits, not debt. Companies that borrow to maintain dividends eventually face difficult consequences. Dividend cuts are painful. They destroy investor confidence and often lead to sharp price declines. Value investors aim to avoid such situations through careful analysis. Key warning signs include declining earnings, rising debt, inconsistent cash flows, and aggressive dividend increases unsupported by growth. Graham believed that moderate, conservative dividends are preferable to aggressive promises. Stability beats generosity when it comes to long-term wealth creation. Dividends and compounding. Over One of the most powerful aspects of dividends is compounding. When dividends are reinvested, they purchase additional shares. These shares then generate their own dividends, creating a self-reinforcing cycle over decades. Reinvested dividends account for a significant portion of total stock market returns. This reality is often overlooked in favor of headline grabbing. Price appreciation. Graham understood that time is the investor's greatest ally. Dividends transform time into a productive asset. Unlike speculative strategies, dividend compounding does not require prediction, it relies on consistency, patience, and discipline. For long-term investors, dividends turn volatility into opportunity. Market downturns allow reinvested dividends to acquire more shares at lower prices, enhancing future income. This process rewards emotional control, a central theme in Graham's philosophy. Applying Graham's dividend philosophy to modern markets differ from Graham's era, but human behavior has not changed. Fear, greed, and speculation remain constant. Dividends continue to serve as anchors of rationality in irrational markets. They remind investors that businesses exist to generate cash, not excitement. Today's value investors can apply Graham's principles by focusing on dividend consistency, financial strength, and reasonable valuation, technology has expanded opportunities, but fundamentals still matter. Dividends remain one of the clearest expressions of fundamental strength. By integrating dividends into a disciplined strategy, investors can reduce risk, enhance returns, and maintain emotional stability.